The retail trading world wraps quantitative architecture in layers of fake complexity. You don't need a PhD in physics to trade like a quant. Simply replace human eyeballs and emotional guessing with strict mathematical laws. The amateur approaches the market with the mindset of a gambler standing at a roulette table. Every single execution becomes a high-stakes, emotional drama. A win makes them feel infallible. A loss sends them into a spiral of revenge trading. This happens because they rely on unmeasurable visual intuition. Staring at a chart and guessing that a green candlestick looks powerful enough to break out is a volatile variable. It changes based on your mood, your daily fatigue, and your inherent biases. An institutional quantitative engine room operates entirely differently. The messy, indicator-heavy retail chart is stripped away and replaced by a digital telemetry interface. Hard data and algorithmic parameters dictate the action, neutralizing human visual bias. True algorithmic edge does not require predicting the future. It requires executing a strict, rules-based mechanical system that extracts profit from the noise over time. To build this architecture, we start establishing the first pillar, a baseline of pure mathematical expectancy. This principle deliberately divorces the operator from the outcome of any individual execution. The second pillar replaces human chart reading with objective, hard-coded programmatic state filters. The system defines the exact condition of the market, removing all hesitation. The third pillar takes advantage of order book thermodynamics. We identify and exploit structural liquidity vacuums to capture explosive market moves. Abandoning the impossible task of prediction is the only way to escape the emotional gridlock. Binding your capital to geometric laws provides a structural alternative to guesswork that destroys most accounts. Mathematical expectancy is the absolute bedrock of any structural quantitative system. Without it, the rest of the architecture has nothing to anchor to. Amateurs operate under the fallacy that accumulating wealth in the markets requires a 90% win rate. They spend years searching for a perfect indicator that never loses. This chart shows the exact opposite approach. The institutional model relies on engineering a strict asymmetric reward-to-risk profile. For every 1 unit of risk taken, the system targets 3 units of reward. We pair this 1-to-3 reward-to-risk ratio with a win rate of 45%. Over a small sample size, say 10 or 20 trades, these data points mathematically make local losses inevitable. Short-term results will look unpredictable. But when we expand that exact same sample size calculation out to 1,000 executions, the net distribution maps a different outcome. The accumulation of those asymmetric payouts forms a steep vertical equity curve. The law of large numbers takes over. As long as the 1-to-3 mechanical parameters are strictly followed, the math produces a net positive distribution. Shifting focus from the individual trade to a sequence of 1,000 changes how an operator handles an entry. A single trade loses its emotional significance. A win is not a victory, and a stop-out is not a failure. Each outcome is nothing more than one minor automated data point inside a broader sequence. The operator's only job is to manage the power transmission. They execute the signal flawlessly, manage the risk parameters, and let the probabilities work. Binding executions to these probabilities removes the requirement for human judgment during the trade, sidestepping the emotional traps that lead to account liquidation. With the probability engine established, we have to transition to the execution engine. How does the system objectively know when it is time to trade? The amateur looks at a chart and guesses if a market is consolidating or choppy. The quantitative approach requires deterministic telemetry, where strict programmatic parameters define the environment. We introduce the is-fused parameter. This is the system's objective mathematical compression tracker, built to identify coiled energy without human input. This graph displays the first raw data input required for the parameter. The engine measures the exact vertical distance, the mathematical spread, between the fast velocity lines and the larger macro shields. The algorithm extracts this spread calculation into an isolatable data track. By isolating the distance between the averages, the system can precisely analyze momentum decay. To measure this, we establish a 20-period historical baseline. Next, we establish short-term active tracking. The system plots a fast, 5-period moving average of that exact same spread over the baseline. A compressed energy field requires a specific boundary set at the 60% threshold. The system state officially changes the moment the 5-period spread average drops below 60% of the 20-period baseline. When that math hits, the matrix overrides the display and locks into a solid titanium gray fusion rope. This mathematical lock forces the system into an absolute flat protocol. There is zero debate about market conditions. During this protocol, the system stands completely aside. It halts all executions, preventing the operator from trading in low-probability environments. By strictly quantifying market chop, the algorithm neutralizes human hesitation. You cannot execute without a statistical edge, because the machine will not let you. Once the mathematically defined compression state reaches its limit, the market's kinetic energy inevitably releases. We have to examine what occurs environmentally at that exact moment. The retail matrix assumes that massive vertical price expansions are driven entirely by overwhelming active buying volume pushing the market higher. The reality lies in order book thermodynamics. This mechanical principle explains why price frequently accelerates vertically right when standard retail indicators suggest the asset is overbought. This diagram illustrates a limit order book. Notice the stacks of resting limit sell orders placed by institutions. These sit heavily in a vertical column above the current price, acting as physical barriers to upward movement. When an objective squeeze triggers a major price expansion, institutional execution algorithms must immediately adjust to balance their delta inventory. To protect their positions, institutions systematically pull and cancel their resting limit offers across the order book. This creates a liquidity vacuum. The absence of structural anchors forms a literal friction-free slipstream. The price violently snaps upward through the empty channel, encountering zero resistance. Retail traders see this rapid vertical movement, assume the price is too high, and panic. They attempt to short the top of a freight train because they do not see the structural void pulling the price higher. The price will continue traveling through the vacuum until it crashes into a macro-gravitational boundary. Institutional algorithms use sovereign anchors, like the daily 200 EMA continental crust, as the physical targets that eventually stop the void. Understanding these liquidity voids allows the operator to execute in the slipstream. You ride the momentum expansions safely into the macro targets, rather than fading them based on faulty visual intuition. The architecture requires combining these 3 structural layers into one continuous chronological execution cycle. The sequence is strict. The mathematical state filter confirms compression below the 60% threshold. Once that alignment breaks, it triggers the entry directly into the order book's liquidity void. The resulting execution is immediately bound by hard structural invalidation lines. The position size and trailing stops are locked, and the trade is logged directly back into the 1 to 3 probability matrix. Every entry, every stop, and every position size is dictated by geometric laws. Human feeling is removed from the workspace. In this framework, the operator manages the rules of the mechanical engine rather than speculating on the direction of a single candle. Quantitative trading requires stopping the attempt to predict the future. Success comes from executing a repeatable mathematical rule set that isolates a statistical edge within the noise. The architecture requires combining these 3 structural layers into one continuous chronological execution cycle. The sequence is strict. The mathematical state filter confirms compression below the 60% threshold. Once that alignment breaks, it triggers the entry directly into the order book's liquidity void. The resulting execution is immediately bound by hard structural invalidation lines. The position size and trailing stops are locked, and the trade is logged directly back into the 1 to 3 probability matrix. Every entry, every stop, and every position size is dictated by geometric laws. Human feeling is removed from the workspace. In this framework, the operator manages the rules of the mechanical engine, rather than speculating on the direction of a single candle. Quantitative trading requires stopping the attempt to predict the future. Success comes from executing a repeatable mathematical rule set that isolates a statistical edge within the noise.